Hey guys, John Soroselli here, and I have with me a very good friend of mine, George Shuchuk, CPA. And there's been a lot of talk recently about the tax plans, the tax revisions, the tax simplification. George is here to give us a lot of insight on what that actually looks like. Not really a simplification, but for more of the details as it applies to real estate, as well as to you, those who own your own business, we're going to give you about 10 minutes or so with some real great stuff. So George, take it from there.
John, thanks. Thanks for having me here in lovely Huntington Beach. You know, the tax reform, we're just going to cover the tip of the iceberg. There's so much information there, we're kind of just scratching the surface. So ultimately, we're going to talk about a little bit about the business. We're going to talk about the tax rates, talk about some of the things affecting your personal return, and then come back to real estate investors, okay? So first off, the tax rates are coming down, okay? So if you were in a 28% bracket before, you're probably gonna be in a 22% bracket. If you were in the top rate, 39.6, you're going to be down to a 37% bracket.
Okay, so where were you if you were in those top brackets before? What was your income level?
It was over like 600,000.
And where was the next level down about?
So let's go back to that 28%, which was 165,000 of taxable income.
Okay,
so not your all income. That's couples.
Awesome.
Married filing joint.
So $168,000 was 28%.
Right.
Okay.
Now it's down to 22%.
That's a big savings. Okay.
But your taxable income is probably going to go up. The reason is itemized deductions.
Okay.
And the reason is that your state and local taxes, your property taxes, your income taxes, and your DMV fees, they're limited to only $10,000.
Okay. So state and property and income taxes are limited to $10,000. So my real estate taxes are lumped into that category with some of those other numbers.
Correct.
Okay.
And that's only on your personal property and your second home or investment property, not rentals and not your business.
Okay.
So you still get to deduct those things.
Okay.
So the other thing that we kind of talked about earlier was mortgage interest. Okay. So mortgage interest, if you bought a home or refinanced, or if you bought the home after December 15th, you're limited to $750,000 of that mortgage that you can deduct the interest.
Okay.
If you refinanced it, you can deduct all the interest associated with the original debt.
Okay.
You can still pull money out, but you're not going to be able to deduct that on your Schedule A.
So if I have a mortgage of, let's just say, $1 million that's in existence, I can now continue to deduct my full $1 million.
Correct.
If I have a mortgage, let's just say, of $600,000 that was in previous existence, and I refinance and I take out a $1 million mortgage, I can deduct up to the $750,000 mark now still, and then the rest is non-deductible.
Correct.
Got it. Okay.
Correct.
Still not that bad.
Yeah. Now that $750,000 again, when you're pulling that money out from that 600 to 750, it depends on what you're using those funds for. You don't get to just use it for anything. It's got to be improvement on the property.
Okay.
Okay.
Cool.
So, but if you're taking those funds out and buying into rental property, then you could deduct it on the rental property instead.
Okay.
All right. So there's options there. The other big thing is HELOCs. So if some of you guys have that $100,000 HELOC that you're just using every once in a while, unfortunately, that interest is no longer deductible.
Okay.
Okay. So the one thing though is depending on where you use those proceeds, maybe it can be deductible. So if you use those proceeds for a rental, or if you used it for going into the stock market, then maybe you'd be deducting it against that type of income.
So the $100,000 that I took, right? Well, I can't use it as a mortgage deduction anymore.
No.
I might be able to use that same money I took on a HELOC and classify it as a different deduction.
Correct. Depending on where you use the money. So for your CPAs, when you go out for next year for 2018, you're going to want to try and figure out the history. Where did I use those proceeds from?
Got it. Okay.
So another thing for employees, unfortunately, on those itemized deductions, you no longer have those miscellaneous itemized deductions.
So those were 2106 expense, non-reimbursed expenses.
Right.
Makes my life a lot easier.
There you go.
Okay.
For the financing.
For the financing, yeah.
So, but the key then is go talk to your employer and see if they can start paying some of those expenses. Maybe you might have to give a little on your salary, but then at least you're getting all those deductions and you got less salary, less income to be paid on
and then you probably can buy less house. So let's wait on that. Let's figure out exactly
there you go.
what
Talk to John first before you change your numbers.
All right,
there you go.
So there you go.
All right. So some other areas, the exemptions. So before, a family of four used to get 4 exemptions. It used to be about $16,000 deduction. Now, with the new law for 2018, you don't get that exemption anymore.
Okay.
The thought from the government was that, okay, we're going to give you more standard deduction, which is your itemized deductions or a standard deduction. So they tried to play off on that they're going to give you more of a standard deduction. But if everybody's itemizing, then you're going to lose that $16,000 deduction. That's why your taxable income is going to go up, like I talked about earlier.
Okay.
So, but another thing that they have come out with, though, is if you do have younger kids under 17, they've increased the child tax credit. It used to be $1,000, now it's $2,000. So they're trying to offset some of that exemption stuff.
Okay. So it basically just depends on what your profile looks like,
Right.
on whether this is a benefit or not.
Right. So, I mean, ultimately, you're going to need to look at your tax situation maybe mid-year, especially if you're an employee. Get your pay stub out and take a look at it and maybe try and calculate some taxes for the next year. Get your tax advisor to do a projection for 2018 to make sure that you're not going to owe tax.
Yeah, I remember we talked a little bit about that previously when we were talking one-on-one, and that's your employer might be, and correct me if I'm wrong, not withholding enough funds for you, and you might end up owing taxes, correct?
Right. And that's because the government tried to do a new tax table to allow and put more money in each person's pocket. But unfortunately in California, because we don't have the state tax deduction anymore, most people in California are going to possibly owe some taxes next April because they got less withheld out of it.
So you're getting more money in your pocket today. You think everything's awesome.
Right.
You think you're going to still get that refund at the end of the year, and you might actually end up owing money.
might.
So that's
You might.
important. So you want to make
It
sure you
is.
certainly get with somebody early on to make sure you strategize properly and maybe increase those withholdings, right?
Especially if you're buying a new house, you know, a $3,000 tax hit in April next year, that's going to hurt.
Yeah.
Okay. So another thing that's coming up is, you know, some people are an AMT, which is alternative minimum tax. It's an extra layer of trying to do taxes, trying to get everybody to pay evenly. So luckily, because you don't have the state tax deduction anymore or the miscellaneous employee deductions anymore, most people are not going to be an AMT anymore.
Okay.
So that's one nice benefit they gave us.
Okay.
Ooh, yay. The other thing is I wanted to get into alimony. So if you're thinking about getting divorced, make sure you get it done before the end of 12/31/18.
Okay, so you have the year to
You
get
have
divorced.
this year
right?
to get your divorce
All right,
done.
So
So just a little benefit, just something to
marriage
think about.
advice, divorce advice,
Yeah.
mortgage advice, whatever
Yeah,
you need.
a little bit of
right?
everything,
Okay.
right? So the other thing I wanted to get into is the state taxes. You may have heard that they've increased the exemption. It used to be about 5.6 million. Now it's 11.2 million.
Okay.
And that's per person. Okay. But that's going away in 2015. So even though your estate is under the 11 million, you still want to talk with an estate tax attorney and tax accountant, because there's some things you might want to do just to protect yourself if you still have that estate when the laws go away. Okay.
So I love tax.
Yeah.
Not that excited about tax like I'm sure you are. So
Yes.
so let's get a bow around this. So if you're still
Okay,
here,
I want to add one more
Yeah,
thing.
go ahead.
Okay, businesses and people with rentals.
Okay.
You get now a 20% deduction on that income.
Okay.
There's some limitations when you go over 315,000, but there's a good opportunity for you there.
Okay.
So just talk about it.
That's
so
awesome.
kind of wrapping this all
Yeah,
up.
yeah.
We talked about a lot of different things. There's still a lot more out there. We just kind of scratched the surface. So ultimately, there's a lot of planning opportunities that you should discuss with your tax advisor. Talk with them mid-year and end of the year so we can do some things for you and save you some taxes on the ballpark. And with that, you know, keep financing and buying property and get John to take care of that financing
look at
for
that. I
you.
wasn't expecting that. Well,
right.
George Shuchuk here, CPA. Truly appreciate you taking
John,
some time with me.
thank you, man.
Thanks,
Appreciate
man.
it.
Enjoy. Hope
Bye-bye.
you guys enjoyed it.